Dive deep into the world of finance and economics with this comprehensive video course. Whether you want to make smarter investment decisions or you're looking to grasp the intricacies of global economies, this course lays a great foundation. The course combines theory with practical insights, paving the way for you to navigate the financial realm with confidence. Sri Ram originally taught this course in person and now has put together an excellent video course on these important topics.
Hello everyone, my name is Shram Chandi and I'll be taking you through this course on economics and finance and how they're relevant for businesses. Throughout this course, we'll be learning a variety of topics, starting with the key concepts for business, capital markets, valuation of stocks, business strategies and financial statements, how to analyze these financial statements, and things like capital budgeting and cash flow. We'll also discuss things like the business cycle and industry analysis, ESG, macroeconomics, portfolio diversification, and alternative investment types. Throughout this course, you'll learn a variety of different topics in all three of these disciplines and understand the interconnected nature of economics, finance, and business in this world. I also have a YouTube channel called Changemakers Media, which you can see in the comments. I would greatly appreciate it if you guys could subscribe there. I share stories on how teens are making an impact in the world and how you can go ahead and support them. Welcome to the first class on economics and finance. So, a thought experiment to start. Imagine you had a magic box and it outputs $1 a day, or $5, or $20, how much ever you want, and it runs forever. How much would you pay for this box? Some people say $1 million, some people say $1 billion. Well, let's look at it from a statistical standpoint. Instead of a box, let's imagine we have a savings account, and it gives you 1.05% interest annually. How much would you have to put into the savings account to generate $1 a day? Well, using Excel, we can identify that the principal, or the original amount we'd have to invest, is $34,761. This is a large amount, and fairly so. This is due to the small interest rate that we're getting in our savings account. Let's look at another example. Imagine you want to buy a house, and the market price is $100,000. You contribute $20,000 towards this down payment and take out an $80,000 mortgage, which is a loan. How much would you have to pay to get rid of the mortgage? Well, if you have an annual contribution of $9,396, you would assume it would take just about 8 or 9 years to pay off the mortgage. But in reality, it takes 20 years. And this is due to the interest rate of 10% applied on this mortgage. If you look towards the bottom, over the course of our payments, you notice that from 2019 to 2020, our balance, or the principal, only drops by $1,400-ish. This is because the majority of our $9,000 contribution is going towards paying off interest on the mortgage. And we see this effect persisting throughout the course of our payments. However, it does diminish as the size of the principal decreases and our interest payments decrease. So, our key concepts for today's class: return on investment and time value of money, and net present value. So, would you rather make a return of $1,000 or 25% on an investment? You can't really compare apples and oranges. So, what is ROI? ROI is a tool that allows you to compare the efficiency of one investment to another investment, thus allowing you to compare apples and oranges. ROI measures the amount of return an investment generates relative to the amount that you invested. So, this is the formula for return on investment. Current value of an investment minus the cost divided by the cost. So, let's take the example of the house again. Imagine you purchased it for $100,000 upfront, and now the market value of the house is $150,000. Using the ROI formula, we can deduce that you had a 50% return on investment. So, why is ROI important? Because it allows you to compare assets of different classes and express it as a percentage. It also provides a basic measure that's universal to compare an investment's profitability, and it's a basic element in all analysis and decisions for companies and individuals. But it is limited. So let's look at this example. In investment 1, you invest $1,000 in some real estate and sell it for $1,200 a year later. So your ROI is 20%. In investment 2, you bought $2,000 of stock and sold it for $2,800 3 years later. Using the formula, you have a 40% ROI. So according to ROI, the second investment is better. But when you look at the time considerations, you spend 3 times as much time to make that 40% ROI as you did for the 20% ROI. Hence, ROI is not the say-all, be-all measure of the value of an investment. Okay, now let's look at the time value of money. Continuous compounding. So let's assume you have a savings account and it generates 10% interest per year over 20 years. Initially, you invest $1 into this account. Over the course of 20 years, with that 10% interest rate, the value of your account will rise to $6.73. That's 6.73 times the amount you initially invested. And this is the power of continuous compounding or compound interest. So, time value of money. This concept says that money is worth more today than in the future because of the potential earning capacity that money has, as seen in the example, and because the power of money decreases due to macroeconomic effects such as inflation. So, would you prefer $1 today or $1 in 5 years' time? With our previous example, we could deduce that we would like $1 today. This is because we have the potential cash flows that money can create during this 5-year period, as well as the avoiding of the potential effects of inflation. Now we have net present value, the last of our 3 key concepts for this section of the video. So, net present value is a pretty straightforward concept, and it's as the name suggests, the net of all cash inflows and cash outflows to determine the value of an asset. Cash inflows and cash outflows essentially represent the income and the sunken costs that an investment has taken. So, how do we calculate the net present value? But before we can calculate it, we need to understand net present value is an important tool to determine the value of an investment. If net present value is greater than 0, that means an investment was a positive investment generating good returns. Before we can calculate what net present value is, we have to understand something called the discount rate. Discount rate is the interest rate used to determine the present value of future cash flows in a discounted cash flow analysis. Essentially, it's the interest rate that the Federal Reserve charges on short-term loans. We use it to calculate the value of money in the future due to macroeconomic policies like inflation, which decrease the value of future cash flows. So, once we understand what the discount rate is, we can accurately calculate the net present value. So let's assume you purchased a vending machine. To purchase the vending machine, you had to spend $10,000. This is reflected in year 0 with a minus $10,000 cash flow, which is a negative cost. In year 1, your vending machine returns you $2,000 in profits. And in subsequent years, it returns $3,000, $5,000, and $7,000. So if you were to add up these numbers, it would give you a $7,000 net present value. However, accounting for the discount rate, which assumes the loss of money due to increasing interest rates, our net present value is only $4,704. Although it's less than the $7,000 that we would have received if money didn't lose value, it's still greater than 0, which indicates that the vending machine is indeed a good investment. Okay, so here we have a Google Sheets laid out with the payments of a mortgage you would make if you were to buy a house. So returning to a similar example, let's imagine we're buying a house for $150,000 this time. So you have a 20% down payment, which is $30,000, which leaves you with a payment of $120,000, which you're going to be paying off with a loan. So let's say your loan principal is $120,000. You have a yearly interest rate of 10%. This means your yearly payment for a 20-year mortgage would come out to $13,896. So as you can see here, over these 20 years, you're going to be paying off this mortgage with your yearly payments. So every year you pay off the exact same amount. However, the principal amount decreases. So in the first year, you start with $120,000. After your first payment, you're left with $118,000, and so on and so forth until you eventually reach 0 at the end of your 20-year mortgage period. However, it's important to note the changes to the principal amount as time progresses. If you notice, from year 0 to year 1, our principal only decreased by just shy of $2,000, even though you're making a payment for almost $14,000. The reason for this is the majority of your payment is going towards paying off the yearly interest rate on your principal, which is 10% of $120,000, which is $12,000. So of your $13,896, $12,000 is going towards the interest, and only $1,896 is going towards paying off your principal. This goes to show you how interest rates can actually end up costing you a lot of money. So a $120,000 loan ends up costing $277,940 by the end to pay off the principal and the interest. So that means you're paying $157,940 on interest. All right, so what are capital and financial markets? What is capital finance and who provides it? And how do businesses and governments obtain financial capital through these markets? So, a financial market is a place where two or more people come together to exchange goods or services. They can be physical places, like a grocery store or supermarket, or virtual places, like, for example, the Netflix subscription page. Although this is less obvious of a marketplace, it is still an area where two parties, the individual purchasing the subscription and Netflix, come together to exchange goods and services, or in this example, a Netflix subscription, which is a service. So, the importance of financial markets. Financial markets are vital for growth of firms as well as achieving individual consumers' desires. Many firms produce goods and services that individuals would not be able to acquire themselves. As a result, it's important for financial markets to exist so consumers can have access to these goods. It's also important for firms. This is because unless they're able to trade their goods and services, they won't be able to make returns on what they're producing and grow as a result. So now we'll go over the stock and bond markets. So first of all, what is a stock? So a stock is a security that represents a portion of ownership in a company. So people can only purchase stocks from a public or private type of company. Public companies are companies that trade their stock on a public platform where anybody can purchase it. Examples are Amazon, Apple, and Tesla. If you wanted to right now, you could go and purchase their stock. Private companies, on the other hand, are held by certain owners, typically the people who started the company. In certain situations, they may choose to sell their stock, but not on a public platform, only privately to maybe their friends and family. So, what are stocks issued? Stocks are issued by companies to raise finances for their goals. These may be expansion, raising money for inventory, and so on. Stocks are also referred to as equity. And as many of you have seen in the Shark Tank show, we see the term equity thrown around. In this example, Kevin offers $400,000 for an $8.2 million valuation. So the company's total equity or stock is worth $8.2 million, and Kevin's offering $400,000, which represents 4.8% of that total equity. So he would be owning 4.85% of the total stock of that company. So now what is a bond? A bond is an instrument that represents a loan made by an investor, which is you, and a borrower. So bonds can be issued by a variety of places, unlike stocks, which are only issued by firms. Bonds can be issued by firms, governments, states, and other government-affiliated organizations. Bonds have four main features. Their issue price, which is what you buy it for, the face value, which includes the price you're buying it for, as well as the interest payments, the coupon rate, or the interest rate, which is the set of payments you'll be receiving over the course of the bond, the coupon date, which is when these payments will be made to you, and the maturity date, which is when a lifetime of the bond is expended and the issue price is returned to you. So, bonds are used typically to fund projects for these organizations. They only last for a certain period of time as determined by the maturity rate when the bond is issued, and they either have fixed or variable payments. Something interesting about bonds is that they're inversely related to interest rates in the market. This is because as interest rates rise, the lower coupon rate of the bonds become less desirable. As a result, bond issuers lower their price. An example of a government-funded project could be developing infrastructure, such as buildings, schools, paving roads, and so on. If the government doesn't already have enough funds to do this project, they may issue bonds to raise capital and pursue these projects.